Hello, everybody, and welcome to our proactive tax planning workshop. I'm Don Houston with United States Investors International at LPL Financial. Today, our goal is to provide helpful information to those who are about to or who have already filed their 2020 income tax forms, and to also provide some proactive tax planning tools for 2021. Before I begin, I find it always important to review that there are 5 key areas of financial planning: preservation planning, retirement planning, tax planning, estate planning, and investment planning. Even though today's presentation is about tax planning, as a comprehensive wealth management firm, we try to always consider the impact of any recommendations we make on not just one, but all of these areas for our clients. Proactive tax planning should always be a key focus when reviewing your personal financial situation. One of our goals is to point out as many tax-saving opportunities and strategies as possible for our clients. This workshop will review some of the broad tax issues and some potential tax reduction ideas. As we go through this workshop, please remember that not all ideas may be appropriate for your personal situation. This workshop is for informational purposes only, and we always recommend you always address any tax strategies with your tax professional. First, let's look at some helpful information for filing or understanding your 2020 taxes. In 2020, there were still 7 federal income tax brackets. Here are the tables for 3 of the most common ways taxpayers file: single, head of household, and married filing jointly. The amounts in each bracket were slightly adjusted from the prior year due to inflation. The lowest bracket of the 7 tax rates is 10%, and the top tax rate is still 37%. Also, the standard deduction, should you not itemize, is shown for each category. Should you itemize, a major change that still has a big impact from the 2017 Tax Cuts and Jobs Act is that the state and local tax deductions that you can take, often referred to as SALT, is limited to a combined total of $10,000 or $5,000 for married taxpayers filing separately for state income and property taxes. This deduction limitation is currently set to remain through the tax year 2025. Long-term capital gains were still taxed in 2020 at favorable rates, so they can be more tax efficient than ordinary income. Those rates are 0, 15, and 20% respectively, so long-term capital gains are usually better tax-wise than many other types of income. Charitable donations are still deductible for those who itemize. However, if you do not itemize, starting in 2020, the CARES Act created a new charitable deduction. It's available to taxpayers who use the standard deduction and do not itemize their deductions. This new benefit, known as a universal deduction, allows for an above-the-line charitable deduction of up to $300. To qualify, the charitable gift must be cash or a cash equivalent, made to a qualified 5013C charity, and should have been made on or before December 31st, 2020. As the tax form here shows, it is the new line 9 on your tax form. Retirement plan funding is always something you should consider. If you have not already funded your retirement account for 2020, there still could be opportunities to do so. To explore this, you can check with your tax preparer or give us a call for more information and details. Here are some commonly overlooked tax items and deductions. Reinvested dividends. This is not a tax deduction, but it is a calculation that is important for taxpayers. Many investors have mutual fund or stock dividends that are automatically used to buy extra shares. That's reinvesting your dividends, right? Remember that each reinvestment increases your tax basis in that fund. That will in turn affect your capital gain calculation when you redeem shares. Please check with your statements, keep good records, and not to forget to include reinvested dividends in your basis. That could result in double taxation of the dividends, once in the year when they were paid out and immediately reinvested, and later when they were included in the proceeds of the sale. If you are not sure what your basis is, ask the fund or us for help. Carried over items from previous years. Don't forget items carried over from prior years because you exceeded annual limits, such as capital losses, charitable contributions, and other certain tax credits. Please make sure if you switch tax preparers that they see your prior year's returns to look for these items. Charitable gift directly made from an IRA. Individuals at least 70.5 years old can still exclude from gross income qualified charitable distributions that are also known as QCDs from your IRAs of up to $100,000 per year. These distributions must be made directly to the charities. Remember to double check on what counts as a charitable contribution or a qualified charitable distribution before using this strategy. Now let's look at some helpful proactive tax planning strategies for 2021. Let's briefly look at the 2021 tax brackets. There are still 7 federal income tax brackets that have been slightly adjusted from 2020, and you can see them illustrated here on your screen. Long-term capital gains are still currently scheduled at favorable rates. We'll leave that one up there for a few seconds longer. It's never too early in the year to start contributing to your retirement plan, as we've suggested earlier in this presentation. If you have any questions about your retirement plan, please give us a call. You might want to examine taking advantage of annual exclusion gifts. For 2021, the maximum amount of a gift tax exemption is $15,000 per person. For example, you can give up to that amount to a family member without having to pay a gift tax. Some ideas for gifting can include contributing to a working child's or grandchild's IRA account, or gifting to a 529 plan, which is a tax-sheltered plan for college expenses. The new above-the-line charitable deduction we showed you earlier for those who do not itemize increases in 2021 from $300 to $600 for taxpayers married filing jointly. For individual filers, it stays at the $300 amount. Also, it could be helpful to formulate a 2021 tax projection. We already know the 2021 rates. A qualified tax preparer should be able to review your 2020 situation and all of your 2021 expectations for income, so they can provide you with the 2021 tax projection. Here are some other proactive tax planning strategies, because we believe that taking a proactive approach is better than a reactive approach, especially regarding income tax strategies. If you are close to the standard deduction level, a strategy to consider is bunching your charitable donations into a donor-advised fund. As this example shows, someone who is slightly over the standard deduction each year can bunch 3 years of charitable contributions into a donor-advised fund in 1 year. This could bring that taxpayer a much larger overall tax savings over, in this example, 3 years. Then, as the other side of the screen shows, from your donor-advised fund, you can still give your favorite charity money each year. Now is the time to explore if this is helpful for your taxable situation to deposit cash, appreciated securities, or other assets into a donor-advised fund, and then distribute the money to charities over time. For more information on this strategy, give us a call. Here we go, we can see it there too. Now we can see the other side of the screen, right? I had to push the button. We'll leave that on there for a second so you get a chance to take a look at what we're talking about. A critical area to review in tax planning is what we refer to as overall family tax bracket management. Now, if you have retirement assets that are not in a Roth IRA, when and who takes distributions can make a huge difference from a tax standpoint. Simply put, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions in their tax bracket rather than you in yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your bracket, convert these accounts to Roth IRAs, and leave them in an account that still has to be taken out in 10 years after your death, but can grow tax-free for up to those 10-year periods. A key step to explore considering your marginal tax rate and your beneficiaries' marginal tax rates each year. So this is a key step. It's a good idea to take a look at if these packages really are beneficial for you. Give us a call and we can help take a look at whether converting to a Roth is a good idea. That's something we try to think about for our clients, especially with large retirement accounts. For some people, exploring a Roth IRA conversion, it could be helpful. Some benefits from Roth IRA conversions include lowering your overall taxable income on the long term. Roth IRAs enjoy tax-free compounding. Roth IRAs also have no required minimum distributions.
Now that law has moved that to age 72 to begin going forward. And Roth IRAs allow tax-free withdrawals for beneficiaries. Whether to convert part or all of your traditional IRA to a Roth IRA depends on your situation. It is best to prepare a tax projection and calculate the appropriate amount to convert. There are several pros and cons to making this change. Please call us or talk with your tax advisor to see if this makes sense. Qualified charitable distributions are still a strategy for retirement savers in 2021. This provision allows for retirement savers to directly distribute up to $100,000 to eligible charities straight from their retirement accounts after age 70 and a half and not pay tax on this distribution. One idea that experts suggest is that if you are charitably inclined, consider using part or all of your required minimum distribution if you're over age 72 for qualified charitable distributions, or what we call the QCD. Like many of the other strategies we are discussing today, this is one you should see us about if you're interested in evaluating your situation. So what can you expect from us? You can expect regular communication, more frequent discussions, review of economic, tax, estate, and investment issues for all of our clients. We hope you've received our special tax report. If you haven't, or if you'd like a copy sent to you, or someone you think may benefit from the information in it, please give us a call and we'd be happy to share this report. Thank you very much. As you know, your health and well-being is our highest priority. We appreciate the opportunity to assist you with your financial needs. And again, if you can think of anyone that could use our services or benefit from the information in this video and with any of the other information that we have, please forward this video to them or give them the information to tune in, and or have them give us their email addresses and we can put them on our distributions to give them value for what we provide to you and our other clients as well. Thanks very much. Thank you for tuning in. We look forward to seeing you soon. Until next time.